Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have a lot to talk about with the EIA show in terms of what's come out new, what is happening going forward. The numbers this past week were very strong across the board. But then what is going to happen going forward? Because we do have a lot of gasoline sitting offshore in the East Coast. We have a decent amount of crude sitting in the Gulf of Mexico. So we're going to go through some of those iterations. And then also what's going to happen with product demand. We expected to see an increase in gasoline. We got there. What happens next? And then in the last segment, we'll go through the global market because we continue to see a lot of weakness, especially with some builds in Europe and slowdowns in Asia. So we'll try to piece that all together, as we go. And just turning to the key here when we look at the WTI futures curve, here you can see that we've come back a little bit in the front month, but we've strengthened across the curve, which is again kind of that net positive when you're thinking about hedging. How do you try to protect yourself? And that's where we start to look at where do we see this strength, and the strength remains above 55. Pretty much through the end of 2023. So it just gives an opportunity for companies to continue to be strategic in how are they hedging, in what are their production numbers going to look like. Essentially trying to protect themselves when you're looking to raise capital. This increase in the curve is just going to help you in terms of what is your net present value, and then try to figure out what does that look like, as a lot of these guys still need cash to keep things going. But again, this is something that still remains fairly strong when we look at the general curve. Then when we turn to some of the new data, as we now have heard from the IEA, EIA, and OPEC, when we look at what is the demand focus. So we all know that OPEC has taken down the first half and picked up Q4. So where they thought Q2 was going to be, they just essentially put it into Q4. So you just had a swap as to where is that demand. So there's really not a really big change in OPEC. The IEA and EIA have both taken up estimates, but it's still below where they were in December, which again speaks to some of the issues that we saw in Europe. And that's why when we look out, some of the issues that we continue to talk about is what is happening in Asia. So here's just a quote from the specific piece. So for OPEC, it was the fourth consecutive increase in its assessment of oil demand this year, which is now 570,000 barrels a day higher than it was in December. But it's also a redirect, which we'll talk about in a moment. The IEA made its second upward revision following a much smaller one last month, though its forecast is still 220,000 barrels a day lower than it was at the end of last year. For the EIA, it was the first upward revision to its 2021 demand outlook since August, with the forecast still 510,000 barrels a day lower than it was in December. So we're just starting to, as we're getting closer to it, we're getting some benefits in the U.S., some pressure remains in Europe, and pressure is starting to mount in Asia, and not just the big countries that we talk about in terms of India, China, but also in Malaysia, Indonesia, and some of the headwinds that are going to persist. Now, one of the things that we're going to talk about more in a few minutes, and then later on in the third segment, is what is happening in China. Because whenever China wants to hide their weakening demand, they go after the independent refiners. And right now they're just doing the same thing on a different day, which is more than 50 companies or the private teapot refiners are going to be checked, most located in Shandong, for essentially breaching protocol, that whether that be pollution, run rates, payments to the state. And this is typically when they're not listening and not cutting runs, which is something that we've been saying based on the contacts we have in China. They've been saying, look, that they're supposed to be cutting, but then when we get the official numbers, they've cut maybe 10 basis points, 50 basis points, where they should be cutting 5-6%. So that's why it's going to be interesting to see how does this dynamic shift, because that will impact demand. Because right now Shandong, or the independent refiners or teapots, depending on the nomenclature you want to use, produce the same or consume the same amount as all of Japan, to give you an idea of just the size. So this is going to be something to watch to see how does this shift the underlying demand within China. Then just to reiterate, what does this mean in general? So when we look at OPEC, how is OPEC adjusted? And when we look at March 31st, and then again on April 13th, you can see where 2Q is and how 2Q came down, and it's really made up in 4Q. So it's not a huge shift in general. So just put this into perspective. The increase in the first quarter simply reflects a similar uplift to the producers group's 1Q 2020 demand estimate, leaving year-on-year growth unchanged. For the second quarter, demand growth has been cut by 520,000 barrels a day from last month's forecast, but it is still above where it was seen 2 weeks ago. But the group's outlook for the second half of the year has become more optimistic. So again, going from first half to second half. And the bigger thing when we look at what is happening in general, in terms of China, so shipments to the world's biggest crude importer were at about 49.7 million tons in March, which was released, and we'll talk about this more in the third segment, and that's equivalent to 11.74 million barrels a day, which is little change from February and the third straight month in double digits. And the reason why is because we actually had deferrals out of February into March. So that was really what helped push March up in terms of just total and aggregate numbers. But that's going to be something that we're going to want to dig into a little bit more. So now when we turn to the U.S., when we look at the crude stock draw in general, it was a solid draw of about 5.9 million barrels a day. But in total, it was actually a draw of 7 million barrels when we look at the SPR, because we did have some drawdown from the SPR of about 1.1 million. Now, when we look at the year over year, so crude on an aggregate year over year is down 11.2 million barrels a day. Against the 5 year, we're still above the 5 year by about 800,000 barrels. Now, the draw this week was mostly driven by Pad 3 and Pad 5, where Pad 2 actually had a pretty sizable build, with Cushing having a small build of 350,000 barrels. So the issue right now is we're getting, or I shouldn't say issue, but the positive right now is that we're getting some drawdowns from Pad 3 because we're still way over where we should be. Year over year, Pad 3 is 20.5 million barrels over and 32.4 million barrels over the 5 year. But things have normalized and continue to get better on Pad 2 and Pad 5. We had a readjustment on crude production back up 100,000 to 11 million. Again, we're getting much closer to 11.1 at this point. The issue has been some readjusting to how they're measuring it and just what does that measuring look like. And then it's also, we did have some downtime caused by some adjustments and maintenance. So when we think about what is going to happen going forward, European oil product shipments for the U.S. have slowed so far in April, just because we had a end of March surge. But that end of March surge has created this big bottleneck where several New York-bound gasoline tankers have already been diverted, and some tankers that were waiting to offload in the harbor have also been moved to try to find a way to offload. So right now we have about 25 tankers hauling about 1 million tons sailing from America to Europe. Right now, some of that has been moved around, but we also have 28 tankers have been booked to load another 1 million tons in the coming days, which is up from about 17 to 19 as of last week. So we're going to get more of that, and then total monthly volume in March was up to 4.5 million tons aboard 114 tankers, which is the most since April of 19. And we expect to see something similar to that, not on the same level. It will come down a bit, but it's going to be back half loaded in April, just given the timing delay. And just to give some concept of, at least 6 New York-bound tankers laden with gasoline have changed course for other ports, primarily on the East Coast. But at the same time, we've had 2 leave New York Harbor and then 2 replace it. So we're pretty much net. There are currently 4 tankers sitting in New York Harbor from 3 days to 1 week. 2 of the 4 already moved, but they to somewhere else. 2 of them have discharging orders, so they will start to come in. But again, this is something that we were going to want to talk about in a bit more detail. Now, the Gulf of Mexico production will increase in 2021 and 2022. This is just from the new short-term energy outlook, which is what they wanted to use to a greater weighting when looking at production, which is why we had some of this adjustment. Realistically, it's just essentially covering what is going to be decline curves. So there's really not too much growth. It's just a matter of, there's going to be a little bit, but it's more a matter of just managing some of that downtime. So what you see that we have that dip for maintenance in general, and then we're going to get some of that maintenance coming back, and that's when we start to see some of the additional production from fields in 2021 and 2022. But you can see as we go back through 2018, it's just a matter of covering decline curves. It's not going to be a huge incremental boost to just U.S. production in general. Then when we look abroad, so this isn't going to capture today's EIA numbers or ARA numbers, but we can kind of back into it. So when we look the previous week, stockpiles fell 6.5 million barrels week on week. But when we look at the U.S., so when we look at commercial storage, which was down 5.8 million or 5.9 million, then when we look at Europe, which was up 6.6 million, we actually have a small net build when we look at just U.S. and ARA. And then when we look at teapots, Japan, which is why we're still staying at the top end of that range. When we look at total land storage, west of Suez is really the biggest driver to that, where we're getting a bigger push to the upside, following obviously not the same pace as 2020, but still pushing towards the top end, keeping that elevated against the 5-year. And now we're continuing to see that push higher in east of Suez, when we talk about what's happening in Shandong, as well as other parts of India, other parts of Asia, specifically India. Then when we look at what is happening in specific regions on driving, you can see Europe had a big drop. North America came under pressure as we had additional lockdowns in Canada. We've had some pressure as well within the U.S., but pressure is relative, because in the big driving areas, we're not seeing anything hugely impactful. In some of the north, specifically Michigan, there is a little bit of an increase of COVID, which is hindering some of that flow. But the rest of Asia continues to drop, which is why when we're talking about India, Malaysia, Indonesia, South Korea, Japan, we're continuing to see some of that pressure, some of it new and some of it just not getting back to normal at the same level as we would like, which is why there remains that amount of just product that's floating around, where if you just look at U.S. data, we're still getting better, and we still are the best in the world at this point in terms of demand. Obviously, China remains up there as well. So we're going to continue to attract that capacity. The issue is a lot of our demand, as we said last week, is starting to flatline. And we're starting to see that here, and we'll go through that in more detail in segment 2. So then when we look at just what is happening in oil inventory, you can see that we're rolling over a bit. We're still when we go back the last 29 years, we're still fairly close to the top of that range. And we're starting to just curl a little bit sooner as we do get more capacity coming online. We still have slower imports, though we are getting floating storage is accelerating, which will start to come onshore as we get more activity out of Pad 3. Looking at Pad 3, we're still at seasonally adjusted all-time highs. Obviously, we're off the highs of 2021. But then when we look at what is happening, off the coast, there's going to be more that's going to come on shore. Which, not to say that this is going to push us higher. It's just going to keep us flatlined here, especially as exports continue to remain under pressure. As we said last week, we expected to see a drop of exports to about 2.6. We came in at about 2.58. So again, this is where we're going to start to see this battle back and forth as imports and exports start to compete to see who's going to be bigger that week. Now, when we look at Cushing again, typically when we look over the last 15 years, typically continues to increase through the beginning of May. So we're still moving in a seasonal direction. It's just we're not moving at the same rate. If you look at just where the actual curve of that average, we're increasing, but it's not increasing at the same steepness as we normally do, which is again that net positive when you think about getting back to normal. Because when we look at where Cushing numbers are, so Cushing is 8.3 million below year over year, 6.8 million below the 5-year average. So again, that we're on the right pace to seeing Cushing essentially maintaining some of this balance. Then when we look at imports were down 409,000 barrels. It was really driven by Pad 2, Pad 3, and on a sizable level, Pad 5. So those are, again, it's always going to be that timing. We expect to see an increase in Pad 3, Pad 2, and Pad 5. Pad 1 had an increase of 160,000 barrels a day. That's something that just based on what we're seeing, that's going to drop, and we're going to get a big spike in gasoline imports just once these ships get to different ports, start to unload. And that's going to impact gasoline, oil imports, where we'll have the reverse happening, where we'll start to see some stabilization in Pad 5, and especially in Pad 3 as we do get some more activation. Now, Pad 5, even though it was down 330,000 barrels, it's still fairly in line with the year over year and the 5-year average. Same thing with Pad 2. So Pad 3 is going to be the one to watch to try to make up some of those shortfalls. Then when we look at crude oil increases, it increased by about 1%. To 85%, really driven by Pad 3, that which is a positive to see as it's starting to get back to some of that seasonal norm. We're still 663,000 barrels over the 5-year average, which is about 1.3% lower. Because if you think about where we are in April, this is typically when we have that seasonal downtime for maintenance, other things where we've already had facilities that have been down for 5-6 weeks, or really since the Texas freeze off, and as they start to come back, it's just essentially it moved our maintenance forward, and now you're starting to see a little bit of an acceleration ahead of seasonal schedule. But as we've been saying, 83 to 85% is where we think we live for the next few weeks. So we're just at the top of where we think we're going to be. And when you look at the breakdown, you had Pad 2 come down a bit, you had Pad 3 coming up. You'll just start to see Pad 2 and Pad 3 essentially swap back and forth depending on something going down, something coming up, and just some of that timing delay or timing and capacity in general. Now, when we look at implied demand, the one thing that we were saying was we were going to get that last spike in gasoline movements, just because we did have that residual on Easter break, spring break. So now we're starting to see some of that normalize this week into next week. So that's why we think we're going to come back closer to that 8.7, 8.8, as we're right now at about 8.944. And if you just look against the 5-year average, that's 301,000 barrels a day over that 5-year average, which again is kind of that net positive in general when we're looking at the implied demand. Now, when we're looking at distillate was up 464,000 barrels a day. That is being benefited by this cold surge that came through. We'll talk about that more in segment 2, where you're starting to get a little bit more support on that level. Jet fuel, fairly flattish. That's something that's going to come down. Where when we look at propane, propane came down by about 547,000 barrels. That's again still, even though it's down, it's still up 358,000 barrels a day year over year, 297,000 barrels a day over the 5-year average. So again, we're starting to get some of this normalcy in terms of where we are on an aggregate level. It's just going to, as we've been saying, we were going to hit this level, we were going to plateau and then start to come off as we find this footing, and we hold this pace for I would say at least through the beginning of May. Just after we have this push, then we'll have this drawdown, and we'll have this normalization closer to that 14 million barrels a day, which we talked about last week. And that's where we always like to look at in terms of just imports, which is why we're going to continue to see imports coming in, especially as we go through April 8th, and the it's really going from disty into way more gasoline, and that's going to help adjust some of the diesel and disty that's in storage versus gasoline. So then when we look at floating storage, so Gulf Coast, we're right back to the 5-year average. Just based on what we're seeing, this is going to stay fairly flat along the 5 years. So even though we're going to import more, we have additional boats behind it. It's just going to be a matter of when do they come in and then get recognized as floating storage. And this is just helping to show how we are getting closer to normal, specifically in PADD 3 on a refinery operation level, because we're right back to where, technically we should be. So even though we have storage where we should be, we still don't have imports where they are, where we're hoping for them to go as we continue to stay at the bottom of that cloud, making that seasonally adjusted low. And it's just, this is something that it's not that we're going to get back to the 5-year. It's just we're going to start to close that gap a bit more and continue to push closer to the highs in general when we're looking at what is happening over those next few weeks. So then when we look at PADD 2, here you can see that we had that the drop along the seasonal norm. And typically we have that drop and then we have that spike. We think that, again, something very similar where we're going to get that move back up. We're going to hold that 5-year average just a little bit above to kind of keep some of that growth or some of that movement, just to average at the higher end of where we normally are between the 5-year and the top of that cloud. So then when we look at what has happened in operation on a refinery utilization rate, again, when we look at that 29-year average, you can see that we typically start to see that steady increase of utilization rates. And just as we've been saying, we had that little bit of an increase. Now we think that we're going to start to flatline a bit and not really hold pace with some of those movements over the next few weeks. But we will, as we get closer to June, and especially after we get after Memorial Day, we'll start to see some of that acceleration as, we are seeing more activity to parks, again, staying more local, but still doing more. So again, that's going to be some of the net positive in terms of some of that movement of product over the next few weeks. It's just, I should say, as we get into the summer, as the next few weeks still, essentially flatline and even drift lower, or again, not by much, just as we start to get some of this push me, pull me as, more imports coming in, a little bit of a softness in demand and then a little bit of a recovery. But again, kind of working within a fairly tight range over the next few weeks.